During its meeting on February 6, 2024, the Monetary Policy Committee raised the central bank rate, the CBR, from 12.5% to 13%. The MPC noted that overall inflation had remained sticky in the upper bound of the target range. All key components of inflation, fuel, food, and non-food, non-fuel, had increased in January of 2024. There continued, albeit reduced, pressure on the exchange rate, and therefore concluded that further action was needed to stabilize prices. The proposed action will ensure that inflationary expectations remain anchored while setting inflation on a firm downward path towards the 5% midpoint of the target range, as well as address the residual pressures on the exchange rate. The MPC will closely monitor the impact of these policy measures, as well as developments in the global and domestic economy, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in April of 2024. Starting with the global context, headline inflation has continued to decline across most economies due to tight monetary policy and lower commodity prices, particularly of oil and food. In general, the inflation in the US, the UK, the Eurozone, and China, as well as India, have, since inflation peaked around September of 2022, have declined persistently. Looking at the core inflation, which responds to monetary policy, we see that there has also been a persistent decline in that component of inflation, but nonetheless, it continues to be above the relevant target ranges. On fuel prices, we see that Marine oil price has declined from its peak. In January, it averaged about $79 per barrel. That is compared to $83 per barrel in 2023. On food, the global food prices, those have continued to decline, although there has been stability over the last few months. But nonetheless, we see that for January there was a decline, and overall, up to January 24, the 12-month change in food inflation was about 10.4%. With regard to the global economic outlook, that is estimated at 3.1% in 2023, and is projected at 3.1% and 3.2% in 2024 and 2025, respectively. In terms of the advanced economies, we see a slowdown from 2.6 in 2022 to 1.6, and roughly it's supposed to, or is estimated to grow at about the same rate in 2024 and 2025. Of interest is the growth for the United Kingdom, which has decelerated from 4.3 in 2022 to only 0.5, and only is expected to pick up to 0.6 this year. And of course that is important because the UK is one of our trading partners. Equally important is developments in the Eurozone, where we have seen a deceleration of growth from 3.4 to 0.5, an estimated 0.5 last year, and this year we expect a growth of 0.9. These are estimates from the World Economic Outlook that is done by the IMF, and these figures were just updated a couple of weeks ago. In terms of the emerging market and developing economies, there's been a fairly stable growth from 2022. I've seen a growth of 4.1, and then 4.1 in 2023, and 4.1 also expected this year, and 4.2 next year. And of course, what is driving that growth is both China and India. In the case of sub-Saharan Africa, There has been, again, a deceleration to 3.3% in 2023. But we do expect a pickup this year to 3.8 and further to 4.1 this coming year. And of course, it's interesting to note the developments in some of the key sub-Saharan African countries. South Africa still is struggling with its growth, which was estimated at 0.6, and this year is expected to accelerate to 1%, which is still quite low. Nigeria has maintained a growth of around 3%, and that is expected to be sustained in the next 2 years. And of course, just to highlight Kenya, although I'll be coming back to Kenya with some more details, according to the IMF projections, you can see that in 2023, the growth was estimated at 5.1. I think later we'll see that our estimate is more around 5.6 and not 5.1. But just to note that growth, even the IMF growth of 5.1 is well above the sub-Saharan Africa average. It's well above the emerging market and developing economies average of 4.1, and clearly is well above the global average of 3.1 for 2023. And also going forward in 2024 and 2025, we do expect Kenya's growth to average at around 5% according to the IMF, and 5.3% in 2025. And these growth rates are well above the global average, well above the emerging market and developing economies average, as well as sub-Saharan Africa averages. Turning to domestic inflation, in January, the inflation remained sticky in the upper bound of the government's target range, and all components of inflation increased in January. Specifically, inflation increased from 6.6 in December to 6.9. And what drove that increase was food, which increased from 7.7% to 7.9. And fuel inflation also accelerated from 13.7 to 14.3. And finally, the non-food, non-fuel also increased from 3.4 to 3.6. In terms of the contribution to overall inflation, in January, food continued to dominate with 3 percentage points, followed by fuel at 2.8 percentage points, and then followed by the non-food, non-fuel at about 1 percentage point. Turning to non-food, non-fuel inflation, we see that it had been accelerating since November 2021 and reached a peak in around February of 2023, and then since that time has continued to decline and reached about 3.3% in November. Of course, of concern, and this is one of the concerns of the Monetary Policy Committee, was the fact that there has been an upward turn in non-food, non-fuel inflation from 3.3 to 3.4 and to 3.6 in January. In terms of fuel inflation, this had, as I said, increased from 13.7 to 14.3, and really the key contributing factor to that increase is electricity. And you can see the contribution of electricity to fuel inflation rose from 3.2 to 4.7, even as transport costs were reduced from 5.4 to 4.7. But essentially, just to note that fuel inflation really is driven by pump prices, electricity, and transport costs. And in the case of January, what resulted in an increase in fuel inflation was the increase in electricity prices. With regard to food inflation, we've seen a steady decline until around August of 2023, when inflation appears to have stabilized and seems to fluctuate between 7.5 and roughly 7.9. In the case of January, as opposed to previous months, we see that the main contribution to food inflation was actually non-vegetable inflation, whose contribution increased from 4 percentage points to 4.3 percentage points. Again, in regard to vegetable inflation, again, just to note, there was a slowdown compared to previous times, and the inflation of 16.6% really comprises of mainly onion, has continued to decelerate globally as well as domestically. Globally, there's been increase in supply, and of course domestically, we've also seen an increase in importation of sugar that has increased the supply of sugar in the market. But also the factories were also reopened in October, and that has also contributed to an increase in supply of sugar, and therefore reduced the pressure on sugar prices has reduced. In terms of the domestic economy and the prospects going forward in terms of growth, for 2023, we are expecting growth of about 5.6. For the first 3 quarters of the year, we had growth of 5.5 the first quarter, 5.5 the second quarter, and an acceleration to 5.9. Perhaps just to... So the fourth quarter, we expect, and I'll come to that slide later on. We expect the fourth quarter growth of 5.8%, and therefore for the year as a whole, we do expect a fairly robust growth of 5.6. This is a revision. Early on, we had 5.5 for the year as a whole. But based on performance through September, we think that it's possible to achieve 5.6% growth. And this fairly strong growth is coming from the agricultural sector, which through the first 3 quarters had increased by about 7%. We expect for the whole year for it to increase by 6.6%. Incidentally, this is probably one of the highest, is one of the highest growth rates in agriculture since about 2010, and has definitely boosted the overall growth of the economy. The services sector continues to perform well. Last year, in 2022, grew by 7%. And we do expect a fairly robust growth of 6.6, which will continue to the next next year. So overall for 2024, we expect agriculture to continue to perform well. We expect services to continue to perform well. And by services, I'm talking about the wholesale and retail accommodation. We expect a recovery in transport and storage, particularly as the exchange rate stabilizes and fuel prices continue to at least stabilize where they are, which is a reduction compared to last year. Perhaps of interest is the manufacturing sector, which for 2023 is estimated to increase by 1.9. This is still well below where manufacturing should be. We expect with the government implementing some of its programs in 2024 that manufacturing value addition in manufacturing will start to increase, and we have increased the growth rate in the manufacturing sector from 1.9 to 2.9. Looking at the leading indicators of economic activity, we see that in the fourth quarter of 2023, we are, I mentioned this a bit earlier, we are projecting a growth of 5.8 in the fourth quarter of last year. And in the past, we have been fairly close if you just look at the previous estimates. And so if we come around, if we get growth of 5.8 in the fourth quarter, then we should be able to achieve the 5.6% growth for the year as a whole. Just examples of agricultural performance. We see maize for the year 2023 to have increased by almost 30%. Wheat also to have increased quite significantly by 62.6%. Rice struggled last year because of the floods. Beans, Irish potatoes, sorghum, all of those displaying significant increases compared to the previous year. In terms of credit to the private sector, this has been trending up since March 2023. Here what we have tried to show is in blue is the overall credit growth, which we have adjusted for the exchange rate depreciation. And the lines in the columns in yellow are just the overall credit expansion without any adjustment to the exchange rate depreciation. And you can see, just looking at the overall credit expansion, it's in December, it increased from 13.2 to 13.9. But also, once you strip out the exchange rate depreciation, there still was an increase in credit to the private sector from 8% to 8.3%. Again, this is just a demonstration of credit expansion to the manufacturing sector, to the trade sector, transport and communication, increased by 20.8%, and also consumer durables. There was some expansion of banking sector credit to the private sector. On the overall balance of payments, just to note that the projected current account deficit for 2023 is roughly $4.3 billion, and that we expect most of that to be funded by the capital and financial account, and to have an overall balance of payments deficit of 982. And going forward for this year, we do expect a widening of the current account, at least in terms of dollars, and to have a current account deficit of about $4.9 billion, and to be mostly funded by inflows of capital, and to have just a residual deficit of $111 million. Looking at the current account in relation to GDP, that has narrowed quite significantly from 2022 when it was 5%, and last year we saw it narrow to 3.9%. We'll come to the reasons for the narrowing. Going forward, we expect the current account to remain around 4% and to remain around that for the medium term. And we think that at this level, this is a sustainable level of the current account. It will be supported by the fiscal consolidation that is taking place. And over the next 3 to 4 years, and we'll see that later in one of the slides, the fiscal deficit is supposed to decline from 5.6% last year to roughly around 3% in the next 3 to 4 years. And that reduction in the fiscal deficit should support maintaining this low current account deficit at around that level. Of course, we expect, because of some of the efforts the government is taking, we do expect an increase in foreign direct investments. And although foreign direct investments are relatively low now, around 0.5% of GDP, we do expect that to pick up. And over the medium term, we would expect that this current account deficit would be funded significantly by foreign direct investments, and therefore just leave the loans and portfolio inflows to fund the rest. So again, looking at the performance of exports in 2023, there was a reduction by 2.2%. This reduction was rather broad-based, and the only items that recorded positive growth were the mineral fuels, which increased by 10.9%. And we also had some positive developments in chemicals and related products, particularly medical and pharmaceuticals. And there we had a growth of about 2.8%. Manufactured goods also recorded positive growth of about 11.3%, and this was mainly driven by cement exports, but cement exports as well as iron and steel exports, and this was mainly to the regional markets. In regard to imports of goods, there was a reduction by 11% from 19.2 billion to 17.1 billion. And again, this was really broad-based, with only food and live animals recording a positive growth of 13.2%. But otherwise, all other categories, the chemicals and related products, manufactured goods, machinery and transport equipment, all registered significant declines. Still in the current account, we had very good performance in the tourism sector, with tourist arrivals increasing by 31% at the end of 2023. We expect this good performance to continue in 2024. Similarly, for remittances, this has been a very steady source of foreign exchange for the country. It has always recorded positive growth, and indeed in 2023 it increased by 4%, and we do expect this 4% to increase to 5% this year, given the strengthened U.S. economy, where most of our remittances come from. On the financial account, again, this is how much we'll be expecting to get from the financial account, and this would include portfolio inflows, foreign direct investments, as well as disbursements from our development partners, multilateral institutions, as well as regional institutions. And we do expect a total of 3.5 billion in 2023 and 4.6 billion in 2024. On the issue of the exchange rate, what we have included here is a comparison between the indicative rate that the CBK used to quote and the interbank rate, where the actual transactions would take place. And you can see, just going back all the way to 2023, there has been a gap between the interbank rate, where transactions take place, and what the central bank was publishing as the interbank rate. This was an indicative rate that the central bank published. So we decided that to only have one rate and avoid this parallel rate. And therefore, starting in 2024, we are now just publishing one rate, which is the rate at which the transactions actually take place. In terms of the central bank's usable reserves, these have increased between end of December and February. You can see the increase from 6.5 billion to 7.1 billion. And this reflects the disbursements that we received from the IMF, but we also got some disbursements from the TDB. So our reserve position is strengthening, and we expect that to continue to strengthen. In terms of the fiscal performance, as I did indicate, you can see the expected fiscal consolidation, which is just another word for reduction in the fiscal deficit from 5.6 in 2022 to 2023, from 5.6 to 3.1 in 2027-28. The deficit for this year, 23-24, we have shown as 5.5. This is actually what was in the supplementary budget, supplementary one. We understand from the National Treasury that there will be a supplementary two, and that deficit will be reduced below 5%, and therefore we'll see a much smoother fiscal consolidation from 5.6 to somewhere around below 5%, and ultimately to 3.1%. And this profile of fiscal deficit reduction should be consistent with reducing our debt to the sustainable levels that Parliament has approved of the 55% of net present value of debt to GDP.